My name is Jeremy Grant. I'm quite familiar with conferences like this. I was involved in covering this space as a journalist for many years at the Financial Times. So it's nice to be back associated with Eurex. I'd like to just bring my panelists onto the panel one by one, which is a new one on me. First of all, I'd like to welcome for our inflation panel Thilo Rosberg, who's the head of FIC and Markets at LBBW, Landesbank Baden-Württemberg. Thilo. Next, we have Martin Luck, investment strategist at BlackRock. Welcome, Martin. And Fritzi Köhler-Geib, who's chief economist of Kreditanstalt für Wiederaufbau. I hope I pronounced that right.
Oh.
And last in today's inflation game show is Goya Subramian, managing director, co-head of EU rates trading at JP Morgan. Welcome, Goya. Thank you. Thanks, everybody. I cannot, normally you would think an inflation panel, what are we going to talk about? I mean, inflation in normal times would not possibly fill 45 minutes of a panel. But as we know, and we could hear from the previous speaker, Sabine Mauderer, there is an enormous amount of uncertainty over the direction of inflation and interest rates, thanks to, I mean, you name it, basically. And what's astonishing about the period that we're in now is that a lot of this was completely unknowable 2 weeks ago, I would say. And this panel is taking place also on an interesting day. You've seen the inflation figures out of the country where I flew in from this morning, the UK. 10.4%, estimated 10.1, I think, so much higher than people. There was a bit of an upside shock there. You have Jay Powell in the US, which at 7 p.m. German time, I think I'm right, the decision is made on the interest rate decision, 2 p.m. Central Eastern Time. So not that we're going to be able to influence him on this panel, but we will try, perhaps. And I was reading up a little about this beforehand, because I will say I'm not an inflation specialist, even though I worked at the FT for a long time. And there was, I think it was the FT, possibly the New York Times, described Jay Powell as having to try and be a firefighter and a policeman at the same time, which I think encapsulates his dilemma, given what's happened with SVB, Signature, Credit Suisse, and the shock, the credit shock there, but then the unexpected prints in relation to, CPI, the employment print and everything else that's going on, and stubborn inflation. You just heard Sabine Maurer talking about 9.3% in Germany, I think. Let's not forget also Lithuania, 20%. I mean, what's interesting about the Eurozone now, I think we can maybe get into this, is the variance across the Eurozone when one is trying to think about Eurozone inflation. And that's where I'd like to bring you in. Before we get the panel going, we have some polling questions which we'd like you to answer if you would like to. This is a question of going onto your phone, scanning the QR code on your badge, going to this panel and selecting the poll. It should be there on your phone. We'll give you a little bit of time to figure that out, but we have 3 polling questions. We're going to ask you about your expectations for inflation in the first question. And I'm going to ask you the same question at the end of the panel to see if our panelists have helped you to change your mind in any way. The middle question is a little different. We'll come to that later. But I thought I would see if we can get the first polling question up. Where do you think Eurozone inflation will be in 2 years' time? Some of you have already been enthusiastically stabbing at your phones and voting. So less than 5%, about 9%, or more than 12%, which is scary. Okay, so if Sabine Mauderer from the Bundesbank was still here, she would be very happy with a less than 5% result, of course, and 73% of you are making her happy. That's interesting. No, 67%. So it's like a lot of economic indicators and financial indicators, the number is moving around constantly in real time. I'm going to make a note of that so we can compare later. Okay, fine. Well, obviously, only 9% of you think it's going to be at a crazy level. Anyway, so to my panelists, thank you very much, everybody, for that. I mean, the one thing that strikes me from this morning's proceedings and reading around is the inability of predictability or predicting tools, predictive analysis to try and get us to where we need to be with getting a handle on inflation. And I wanted to talk about that a little bit because the market's ability to predict inflation is quite poor, I think it is fair to say. And I think that we're at one of those inflection points where this is really being brought into a sharp focus. Has anyone got this right, do you think, yet? Can you point to anyone or anything where we can look and say, well, actually, if you look here, there is some sense of where we think it might be going? So the sort of, let's get some good news out there.
I'm happy to take that. So, I mean, I guess the answer, if you look at sort of like the inflation markets, is probably no. If you look at sort of, our economists' ability, whether they be central bank economists or bank economists or armchair economists' ability to predict inflation, the answer is no. But what does seem to have been the case is that the bond market does tend to do a pretty good job of predicting inflection points. I mean, it's been the case for a while that the bond market's been inverted. It's kind of been ignored to a large extent by the equity market. And yet here we are with like, full-blown banking crisis on our hands. So take what you will of that, but clearly the answer with respect to inflation in particular is no. And I think there's multiple reasons for that. We can go into them, but I think that is a scary observation because given the importance of predicting inflation and understanding the sources of realized inflation on monetary policy, the fact that we don't understand the phenomenon better should be, a cause for worry. And if I worry about anything, it's the fact that that's not sort of like acknowledged sufficiently, that we sort of like plow ahead with monetary policy decisions, even though we don't really know for sure, whether they're going to do what we expect them to do or what we're hoping that they will do.
Are we any better or worse than when I say we, I don't mean us on the panel necessarily, but you know what I mean. Are they, let's call it they then, any better at it than they were 30 years ago? Anyone?
I think one important element is the awareness of the heightened level of economic policy uncertainty. Because I think these are, in that sense, extraordinary times. Take any measure of uncertainty, these are at historically high levels. And I think this also then, in combination with these shocks that we are seeing, and the crisis that we see in very different ways, the energy crisis, before we had the pandemic and so on, lead to a environment in which forecasts diverge much more than under other circumstances. And I think one can say a very relevant step is to be aware of that uncertainty. And I think the ECB and also the Fed are very strongly moving in that direction, saying that therefore you need a robust strategy and need to make decisions that are data dependent and less forward looking. I think that's a very sensible move in this environment.
Martin, what's your perspective as an investment strategist?
Well, I think that it is quite straightforward and easy to explain why inflation forecasting is so difficult. And first of all, it's based on surveys, or it's based on something that is priced into markets, or via swaps, or via break-evens. And that's basically what markets expect, so the relative prices of nominal versus inflation-protected bonds. And now that puts you up to the question, where do we stand? And the reality is that we live in a world nobody has experienced for 40 years.
Right.
We live in a world that is shaped by supply shortages, and this is what is driving inflation. And everybody who is now looking at models is looking at 40 years of data that do not fit the current situation.
Right.
That is what all the models you come up with produce wrong results, which is quite straightforward. And so this is extremely tricky now that we find ourselves in this new environment to really get our head around the reasons for this inflation. Now we're talking a lot about energy prices, we're talking a lot about supply shortages and broken supply chains, etc. But what really kind of created this revival of inflation in the first place, remember, we have been fighting deflation for 15 years in this region. And now that we have inflation, where does it come from? It comes from a supply-demand mismatch in the restart after COVID. Inflation was dead, and now it's alive, and it's alive and kicking, but it will come down to quite different levels. So this is how I look at it. Inflation forecasting is literally impossible right now because, as Mario Draghi once famously said, we tend to extrapolate the little that we think we know about the present into the future, which of course produces wrong results.
And of course, at this current time, because there is such a small data set on
Exactly.
what we're living through now, you can't extrapolate very much. Mm-hmm. All you've got is the data set of the last 30, 40 years, where, as you say, disinflation and ultra low interest rates in the last 20 years. And I would imagine also there's a generational issue here. A lot of the people trying to do this assessing weren't around in those jobs 20, 30 years ago. They've never seen it, right? Thilo.
Yeah, you're right. Definitely it's a new thing, and the recent data doesn't help us anyway in projecting or predicting what's going to happen. But don't forget, inflation is a very emotional thing. And so when you talk about markets and think if markets reflect inflation projection or inflation expectation, I think there are a lot of irrationality with it. In the sense, maybe even more than when you look at rates or equity. Because yes, we all grew up maybe in a time when inflation was not a serious issue. Well, we all know the stories of our grannies telling us, how money went out of the door by inflation. And in somehow, in particular in Germany, I sense it's maybe even more emotional than in other areas of the world. And then, if you look at market predictability or predictive power of the market, just from a theoretical point, prices reflect all the information that there is at the given time. But any kind of surprises that come along, such as, say, geopolitical impacts or the pandemic, cannot be reflected in that price. So, yes, how could a market be a predictor in that sense?
Yeah.
And then, sorry, one last remark. Even in the very volatile last 2 weeks, when you were looking at the real rate, it was relatively stable, given what you would expect from, say, the market turmoil that we saw when the market was pricing out any kind of rate hikes in the aftermath of the financial instability that we've seen.
Do you think the central banks, and I mean the big ones, the Fed, ECB, Bank of China, are looking at the right data now? Sticking with this data point and the fact that they can work with is the small data set that they have, plus this mindset and habit of having dealt with a very different data set. Are they looking at the right data set now, given the fact that there's a lot in the mix here, including not just supply chain, which you mentioned, Martin, which is very true, geopolitics, dislocations there of various kinds, in energy markets, for example, supply and demand imbalances in other ways? Are they looking at the right data, or would you say to them, actually, guys, you've traditionally looked at employment and CPI and so forth, look over here? Anyone?
You didn't mention climate neutrality. They are also looking into the trends that are necessary there. So I think that central banks are looking at a vast number of indicators right now, and they make it very clear. And I think that is what the ECB meant and communicated with regards to a robust strategy, basically defining those areas where they track data. And I think the surveys that they have in various areas, be it inflation itself, their expectations, be it the credit market, be it the labor market tracers, and so on, are very relevant. Of course, when you think about it, the ECB, I don't think, has a military department that looks into build-up of military along borders. So I think there are those shocks that come from outside the economy. By the way, COVID being another one of those that do have tremendous impact. Those that are foreseeable, that are more structural, I think they are taking into account, and this is precisely where the move towards covering the impact of climate change is addressed.
That's very interesting. Do you agree with that, the rest of the panel? This climate, what was the phrase you used at the beginning, climate?
The move towards the transformation to climate neutrality and basically the impact of climate change.
Yes, it was the climate
where
neutrality.
both effects, of course, do impact price.
Yeah.
One through the damage of extreme weather events, and the other through increased CO2 pricing, where, if not mitigated, climate change will have much larger price effects through damages, through extreme weather
And you're saying
events.
that the main central banks, you think, are taking that into account, or you're saying they should?
They are taking this on board. That was part of the strategy review that the ECB undertook. Then we can discuss whether the instruments are the right ones, but I think to look into this area of foreseeable changes that will impact the price level is absolutely the right way to move.
And is the Fed doing that?
I think to a lesser extent, and I would say that maybe is an area where the ECB is at the forefront.
Okay. Do you guys agree with that? Is climate neutrality and that being in the mix as a price influence, as an influence on?
Well,
pricing?
what we heard in the previous talk, it was made very clear from the Bundesbank that all these are influential on the structural inflation. And I think indeed that might be a game changer in the sense that the world as we know it, with everything getting cheaper by being more effective and by globalization and in working supply chain, has changed with the pandemic and the new geopolitical instabilities that we see. So yes, I agree. We are on a different level, different era, and I don't think anybody can fully grasp what that might mean for inflation in the forthcoming few years.
So in many ways, what I hear you talking about is that we are in an era where actually when you look at what you need to assess inflation and future and predictions of inflation, you need to take into consideration a number of different data sets or factors that were not considered in the last 30 years. That's the bottom line, right?
Mm-hmm.
Yeah, that's very much true, I guess. And one thing is for sure that this year it will be extremely complicated looking at inflation, because we're now talking about an inflation. We're talking 8.5%. Eurozone, we're talking 10%, UK, et cetera, but this is all driven by extraordinary effects that will peter out in the medium term. Once the base effects kick in, these effects will go away, and actually we will see probably over the next couple of months already a very rare phenomenon. In the US, it could actually happen as early as next month, that headline inflation drops below core inflation. You know, it came very close last month. Headline dropped from 6.4 to 6.0. And core was sticky came down from 5.6 to 5.5 or something like that. So this would be a very unusual phenomenon. And actually then central banks could also change their language, because they're now always talking about inflation per se. What is inflation? It's so many different things. And then so central banks, if they really want to stick to their restrictive policy stance, they will need to switch to core inflation as their core argument. They will really make very clear we're focusing on core inflation because actually headline inflation might drop too low for them to stay on the brakes. And then later this year, to make it even more complicated, what Sabine Mauderer was talking about, the famous 3Ds will kick in, and actually they're already kicking in. And when you were asking the question, are central banks looking at the right data? I'm not sure what data they are looking at. I only know that there is a big, big gap between what central banks are telling the public and the markets on the one hand, and what they really look at on the other hand, because it's totally different things, right? Central bank communication has never been more complicated than right now. And what we will see later on is that these effects kick in, and they're already kicking in the United States, because the Fed is still making us believe that they look at the labor market. The labor market is giving us completely wrong signals. We have record low unemployment in the United States, and it's not that the economy is shooting out all the lights. It's doing okay, but it's not red hot. What this low unemployment rate is due to is actually a shortage of labor supply, because baby boomers have never come back to the labor market after COVID, which is a phenomenon that is earlier in the US. It will also happen in Europe from 25 onwards, more or less. So we will have this phenomenon of labor shortage. What is making it more complicated to look at inflation this year is that all these three phenomena are happening at the same time. A roller coaster in headline inflation, much more sticky core inflation for different reasons still in the US and in Europe, which makes it more complicated still, and then structural inflation drivers kicking in the medium term and already kicking in the United States. So I think it is almost impossible to tell at this point in time what central banks are looking at.
Yeah, and you make a very interesting point about central bank communication, which to the general public, which is obviously a key constituent, has always been around these metrics of, we're looking at the employment rate, etc. And people are socialized into thinking, many people, majority of people probably, are thinking that's what central bankers are looking at. But I think your point is that they are having to look at an unprecedented range of things, and that's not in the communication, by the way, which then brings us back to the markets and their ability to, take pricing signals and predict. If the communication doesn't reflect that complexity, then the markets are not going to be able to respond in the appropriate manner, right? And that's a problem. Everyone's nodding. We've come to a very interesting point here, I think, in this panel in terms of central banks' ability to communicate the complexity. Yeah? Go ahead.
So it's not only the fact that they are struggling to communicate the complexity, it's also that their tool set is actually relatively limited. I mean, it's broad in many ways in terms of liquidity provision. We saw that relatively recently, but in terms of kind of, steering the macroeconomy, their tool set is somewhat limited. They've expanded it and tried and expanded, but it fundamentally sort of relies on, bond purchases and, setting interest rates. And that is a pretty crude set of tools to look at these wide variety of factors. So even if you said, your task is consumer price inflation only, and it's questionable as to whether that is the right target, but that is the target of the most central banks. The ability to affect consumer price inflation through that tool set is really quite limited. So even if they did a perfect job of communicating the complexity that exists in predicting, how those things are going to evolve, then their ability to affect it would still be pretty hampered. So in a way, one of the things that the market has to do is it has to sort of go one step further and not only gauge what the evolution of these target metrics are going to be, what's CPI going to do, but also how is the central bank going to react, and might it overreact because it only has relatively few levers to pull. And what is happening in the US arguably is exactly that playing out. So we've gone from 0 to close to 5% interest rates in the space of 18 months after a 40-year secular bull market. Balance sheets are anywhere from 3 to 4 times bigger than they were in the 1970s. So you could argue that 5% now is like 20% in the Volcker era, that's debatable. Maybe it's not 20%, maybe it's 15%, maybe it's 10%. But the effect of a 5% increase in interest rates is much bigger. Now, will they be successful through pushing that lever so violently in bringing consumer price inflation down? Probably. Would consumer price inflation have come down naturally anyway? Possibly.
Yeah. Yeah.
I would challenge that view slightly, because I do think that we see monetary policy transmission working. We are seeing that credit conditionings are tightening substantially. I mean, that has started at the end of last year, in particular also in the mortgage market, no? But also in the corporate lending market. So I think that we are seeing that monetary policy tools are actually working. The tricky part is also how to influence expectations. And I think there lies a real challenge for central banks. And it goes back to that point that we have so many factors that at the moment impact also those expectations, so that is not fully under the central bank's control. So which also means that I have to send those strong signals that the instruments that they have at their hands to control or to channel price stability, they are using.
I mean, what strikes me about listening to you and this idea of the disconnect between the instruments available to central banks, the interpretation of a far greater range of metrics needed, and then the communication, it's actually rather similar to what happened, I think, to what happened with Credit Suisse the other day. The way it was presented was, UBS is buying Credit Suisse, and this is not a bailout, this is something else, and it's all fine, basically. We're backstopping it, and the Swiss president was there, and so on and so forth, and the UK was kept informed, and the US. There was, and then in the States, with SVB and so forth, it was again presented, I think, by regulators as something relatively straightforward. Actually, when you started to dig into it, you started to get into the complexity around regulation that took place vis-a-vis regional banks compared to the big Wall Street banks. Nobody was thinking about this. That wasn't communicated, by the way, in any of the language as well. So it's rather similar. There's much more going on under the surface in both cases. Regulators are having to deal with, it's another example of having to deal with complexity that cannot be easily communicated to people who need to see signals, I suppose, is what I'm saying. Let's move to the markets, because the markets are the ones that are looking for signals and looking for direction to price discovery comes in here. When we had our call to prepare for this panel, we discussed, how the evolution of instruments linked to inflation were much more widely used than before, which is true, inflation-linked bonds and so forth. And I can't remember who it was, but I think it may have been you, Goya, who made a very interesting thing. You had in terms of the instruments available to the markets, the tools, you said, 4 to 5 years ago, most inflation traders on the street did not have live oil prices. So even the markets themselves are dealing with a situation where, almost dealing with the opposite situation, where it's not like they've been dealing with the same tools for the last 30 years and the same information. The markets haven't been at this all that long in terms of products available to help predictability, which is quite interesting. This is a very broad question. How good are, actually, I tell you what, this is actually a time for the second poll question, and we can perhaps discuss the answer. It's perhaps a good way of doing it. If I can direct you to the second poll question, give you time to, you were very quick, by the way, accessing your polling question, so I'm not going to pause really very long. But the second poll question is, how useful are interest rate and inflation-related derivatives in providing some predictive context for inflation? Very useful, somewhat, or not useful at all? Okay, everybody's plumping for the middle. Oh, well, almost a third for very useful. That shouldn't be, actually, the golden rule for this is you should never have a running commentary on a poll that is still going on, because you risk influencing it, which is perhaps a central banker's dilemma, actually, is you shut up until you absolutely have to. Okay, so somewhat useful. What do we think of that result then? So very useful, 30%, almost a third actually, 55 somewhat, 15 not at all. What do we think of that in terms of your own personal view on the market's instruments and helping to be able to predict inflation or in some way help?
Yeah, so I mean, I would split it up into sort of like interest rate products have been really quite useful in predicting macro events. The pre-call that we had, we were discussing the inversion of the yield curve and how that was pointing to a recession at the time when, frankly, the economic data was pretty strong, and perhaps by coincidence, but certainly it's a repeated observation through macro history. We have kind of like the mess that we had over the last couple of days a few weeks later. So I think that historically bond markets, as Marco pointed out as well, have been quite good at predicting inflection points. They haven't been perfect, but they've been quite good. But then the interest rate swaps, for example, have been around since the 1980s. If you contrast that to inflation products, they're much more niche. They're much younger. They've been around for, I think we did the first one in 1997 or something like that. And the amount of participation, so the amount of kind of like intelligence that goes into them is much more limited. Over the last year or two, a lot more capital has been dedicated towards trying to understand inflation. And so in a way, you could argue that inflation markets now may be better predictors than they were 2-3 years ago. But certainly history is not on their side. The observation is that mostly medium-term inflation break-evens as priced by the market are most highly influenced by what's happening in short-dated inflation right now. And so they've been pretty systematically wrong. The ECB's done research on this and they found the same thing. So it's a tale of two halves, I think. Right. But market instruments in general can be quite useful. Okay.
Thilo, what do you think?
I tend to disagree slightly. I mean, well, on one hand, you're right in the sense that inflation derivatives give a direct exposure to the market and a direct handle to the inflation risk in some way. And we've seen clients, even though they don't have actually a real inflation risk in their mandate, they still are interested or even do trades in inflation derivatives just to hedge that emotional component somehow, I regard it. But it's more, I would rather see it the other way, or say like a secondary round, if you want. So when you see now with the last 2 weeks, markets pricing out interest rate hikes, but that in turn has then an effect that you say, okay, central banks are maybe not raising the rates as anticipated before, so inflation will come down slower. So in that way, yes, but not like looking at the market and saying, okay, forwards are implying this and that and that. That's why I think inflation will move like the forwards imply. I don't buy that at all.
And would Fabrizio or Martin, would you like to weigh in on that, this usefulness of financial derivatives and so forth?
I think it fits nicely with the discussion that we had before. It's one of the many indicators that we at least are looking at, and so I would actually agree with the assessment of somewhat useful to build a complete picture. To your point about the different instruments that are available now, I think I would add that it's also true that trading has speeded up so much over time. So actually there is also so much more information. Then you can say, yeah, computer power has also increased. It's true. At the end of the day, there is a human being in most cases, unless we have artificial intelligence making the investment decisions, but we know that the training of those algorithms is ultimately also done by human beings. So the human brain, in a way, and its ability to process information remains the limiting factor. And in that sense, yes, it's true, there are more instruments, but the speed of action has also increased tremendously. So I would see some limits to the additionality of information and would say, yeah, somewhat useful.
Maybe just one additional thought to this. I think these instruments are not really helpful in predicting inflation because it's just, positioning. or you put your money where your mouth is, or you don't, right? So you could just as well ask people, and then you end up with surveys. But what I think they are hugely helpful in is really gauging market positioning, which I think, the impact of which is not to be underestimated. And it's also very, very important for central banks to see and to understand where their signaling ends up in markets. How do markets really pick up what central banks communicate? And central bank communication is the most important instrument. So it's really important to realize for a central bank just how their communication gets kind of translated into market prices. And for that purpose, these derivatives are very, very important. So I would even end up in the 55% bracket or even slightly above.
Right, okay. Thank you for that. I'm going to turn it over to the audience for Q&A quickly. And I see that with 6.5 minutes to go, we do have 2 questions which have been submitted, and the way you submit the questions is through, again, your mobile device. I have an iPad here where I can see the questions, which I will anonymize. And I have 2, which I'm going to punt across to the panel. The first one is, to fight inflation, why did central banks not go for aggressive quantitative tightening with low interest rates rather than using rate hikes and very slow quantitative tightening? Which of you?
Quantitative tightening is maybe a stronger impact on the market, and given the lack of liquidity that we've seen in the particular last few weeks, maybe a strong quantitative tightening could kind of overdo it on the market. And I think part of the volatility we've seen in the last few days is because people are bound to their positioning and that they've had in the past, given their macroeconomic views. And then if an external shock or even a stronger supply on, say bonds coming into the market, then that creates a distortion maybe that the market just cannot swallow. Because let's face it, the balance sheets of the central banks are very, very big. And that's, if they really want to slide it down in a faster pace than that they've anticipated or communicated, I would find it hard to digest. But I mean, you're closer to the investor than, what's your view?
Well, I think you need to look at the likely changes that have taken place in monetary transition. And why was QE created in the first place? It was created because the money multiplier went down, right? Banks wouldn't lend to each other anymore after the great financial crisis, so the central bank needed to put more M0, more central bank money on the table. This is why they bought all these assets now. So now this blew up the balance sheet of the central bank. So what we need to look at is actually how much money is there in the system, how much money is really relevant for driving inflation, because if we believe Milton Friedman and that inflation is always a monetary phenomenon, then we need to look at this connection between the money that is created by the central bank in the first place. Secondly, of course, we need to monitor the price of this money, which is central bank interest rates. And then we need to look at what comes out of it in the sense of how strongly are monetary aggregates driving the price level of the economy. And that makes it really nasty, is a process that takes a lot of time. So you cannot do that. If you go like the Fed did, like 400 basis points in just a couple of months, like 8 or 9 months, and then you just jump above the neutral rate, and you don't have even time to monitor the effects, and at the same time you take money out of the balance sheet, this is what it leads to. The cracks open up, they are showing, and it was an accident waiting to happen. So we don't need to be surprised by that. It's just that we need to kind of take this as a learning that all these things are interrelated, and once you start tearing at one string, then probably something will happen at the other end of the spectrum. We need to be a bit more cautious, I guess, and that's also a warning for central banks.
Yeah. Let me turn to our next question. We have 2 questions to get through in 3 minutes. Is there a chance that structural effects will be addressed by structural regulations instead of pure quantitative tightening, if that makes sense? Does that make sense to you?
I would say that we also need to be careful what we expect monetary policy to deliver. I think we're actually at a point where this is particularly the case, where we're actually having to do to a large extent with the supply shock. In any ways, we're expecting that monetary policy resolves it. For the structural issues, you need fiscal policy to address those issues. And even with regards to energy prices, you need fiscal policy to set incentives for the private sector to invest in additional sources of energy, just to give one example. And in the same way, I think when we talk about globalization, this is for other policy areas to be effective as well as for labor markets. There are a lot of policy measures, the framework that needs to be set, but much rather by fiscal policy, be it productivity, be it migration, be it labor force participation of people who are within a country. So I would say that that these are challenges that are so large that really the full range of policies need to be considered to resolve them.
Okay. I've got another question's come in, so I'm going to do this in super quick time. This is a speed dating part of the panel now. Why is Switzerland handling the inflation so well compared to the EU? Is it? I don't know. And what can we learn from it? Quickly. Anyone?
Different sources of energy supply and a lower share of energy in their inflation basket. That's easy.
Okay, excellent. And the final question, it says, how did inflation affect the correlations between asset classes? I think it means, how does inflation affect correlations between asset classes, and how should portfolios adjust to those changes? That's a BlackRock question, I would have thought.
Would you repeat that? I couldn't get that.
How does inflation affect the correlations between asset classes, and how should portfolios adjust to those changes? It's quite a general question.
Well, I think what we see is that raising inflation creates raising rates in general, so fixed income is back in the play. And that's, I think, the portfolio changes we've seen in a number of investors.
Okay, great. Final polling question, where we return to the original question and see whether you've changed your minds or not. I suspect the answer is not really. But anyway, could we please have the final polling question back up and vote, please? Same question. Having listened to the panel, where do you think Eurozone inflation will be in 2 years' time? Okay, make your minds up. Good. Right, that's interesting. 54% of you say 5%. When you first voted, it was 62. The second, middle rank, that's changed quite dramatically. 40% say 9%. It was 27 before. And the last category, 11% or 12% is roughly the same. So that's interesting. It's quite a change in that middle ranking of it's around about 9%. So people have raised their, what have I done? Have I done that right? Yes, people have raised their expectations of inflation as a result of our deliberations on this panel. So you've made life more expensive for us all. Thanks, guys. Anyway, thank you so much to my inflation panel.
Thank you.
Thank you.
Thank you.